Have a super interesting morning this morning. But before I even start, I want to let you know you want to absolutely watch the Optimus video with Brian Wang later this morning. He brings totally new thoughts to the subject with plenty of facts to back him up. And this is a don't miss. That's why I'm bringing it up right now. Hit notify if you haven't done it already. You want to see this video later this morning. Okay, on to the regular scheduled program. We've got plenty. Sawyer Merritt this morning says, news, Tesla has cut Model Y prices in China by up to 2.8%. Model Y rear wheel drive is 2.8 drop in price. Model Y long range drop of 2.1. Performance doesn't change. Model 3 also a 6% drop in price. Model 3 long range a 3.9. Well, Gary Black responds to that. He says, Tesla cut prices by 2.6%. We estimate this will cause Tesla's analysts to cut 2024 adjusted earnings by approximately $1 billion, or by 0.25 to 30 cents a share, by 25 to 30 cents a share. The current Wall Street estimate is 383, a 7% decline for next year. We'll cut our own adjusted EPS from 420 to 390. We assume no incremental volume growth since Tesla's Chinese competitors are likely to meet the Tesla price cuts, similar to what happened last year. He says goes on to say the new price cuts and negative earnings revisions are likely to pressure Tesla stock tomorrow, although today's 3% decline may have partially discounted this cut. Or maybe the fact that the Model 3 in the US had to move delivery dates back a month. Oh, this is me now. I'm sorry. This Gary Black is done. This is me saying, or maybe the fact that the Model 3 Plus in the US had to move delivery dates back a month already. They've already moved them back a month. Will give the market a reason to celebrate. Oh, wait, that won't even be reported. And it isn't. Nobody anywhere is reporting this. All right, so Jeff Lutz responds to Gary Black. This would be a really uninformed take by analysts, as this is a unique situation. Model 3 China is in quarter two of its ramping September to December. The first quarter has very high cost of goods for minimal utilization, bringing the product up the ramp curve. So the GA costs are very large, lumpy, inbound logistics, bringing all the new parts in. So given the 50% plus reuse, they'll hit peak utilization probably this quarter or next, taking huge chunks of cost of goods out. The 2 to 6% versus the ramp quarter would be pretty doable. If this were the old M3, I'd be more agreeable with a margin cut. Devil is in the detail, but Tesla has been on the underside of every gross margin call the last 5 quarters. Gary, they increased prices on these trims in quarter 4, and we haven't seen those earnings. So what is your baseline? For example, my long range had 9,500 RMB of increases in November 2023 and 6,500 RMB of cuts here. No net, still 3,000 RMB higher in pricing alone, since the higher last earnings have not even looked at the cost of goods. So my question is, and all of this is, could Tesla now be dealing with momentum problems? I'm talking about the stock at this point. The steady drumbeat of negativity, both false and true, is likely having an impact on market participants. Add to that the reality of the market possibly smelling a recession. The bank news this morning, not at all what you're going to want to hear on the first day of the earnings season. So let me know in the comments below. Have you trimmed your Tesla position at all in order to take advantage of some other opportunities out there, or just trimmed it in general because you're worried about what's happening in terms of the market momentum, or just in terms of maybe you shouldn't have that much in the stock? I have not touched mine, just to let you know, have no intention of touching it. So that's my position. All right. You're obviously good. This is Randy Kirk, by the way. Oh, yeah, that. And please hit like and subscribe and notify. You're obviously going to want to hear what Larry has to say about today's market tonight when we do Good News Friday. And we'll find good news. Believe me, even last night we found good news. We'll have some good news in what I'm about to report, but there's growing anticipation of a recession. and the horrific handling of the various wars by the current administration is not helping. Again, let me remind you, look at yesterday's Brian Wang video for sure. I'll put a card up on that later. And then over the weekend, I'm going to give you the beginning a 5-part series on 50 predictions and prognostications that I have about 2024 with regard to Tesla. You'll want to see all 5 of these. I know, 50. Are you kidding? Anyway, that's coming up this weekend. And then, of course, you want to buy some of the, you just told me to remind you. That's it. I'm just going to remind you to buy your Cybertrucks. All the information you need to do that is down below, and then join Patreon. All right, let's get into the news here. Biden orders airstrikes on Houthis in Yemen. While this is what we'd expect and hope for at a bare minimum, given what's taking place in the Red Sea and at the Suez Canal, we have to ask, would the Houthis do this if the leadership in Washington was stronger and seen as such? Why are there so many outbreaks during the presidency of somebody who is seen as feeble and possibly suffering dementia? You realize, of course, perception is everything. It doesn't matter whether Joe Biden is suffering from dementia. He appears to be. It doesn't matter whether he's feeble. He appears to be. It doesn't matter whether he doesn't seem to be a strong president who's willing to put forth a position or a perception of strength in order to keep people from doing all these incursions. It's on his watch, and I'm sorry, it's looking bad. All right, and that's got to be on people's minds. The first banks, then we go on to this wonderful news. The first bank earnings are in, and very disappointing. Not what you want to hear on the first day of the earnings, as I said above. Here's Barron's take. Citigroup reported a net loss for the fourth quarter of $1.8 billion. The loss comes after Citigroup previously disclosed a litany of one-time charges, including Citigroup reported revenue of $17.4 billion. That was a miss. Missed on revenues, and their earnings per share was expected to be, expected 10% earnings on per share, and of course they had a loss. Then JP Morgan Chase comes in, reporting fourth quarter earnings per share of $3.04, revenue of $38.6 billion. But the nation's largest bank, JP Morgan, reported net income of only of $9.3 billion, for a 15% drop from the $11 billion in the same period a year ago. JP Morgan said an FDI special assessment, which is being applied to other banks as well, cost it $2.9 billion and decreased earnings by 74 cents. The bank says earnings on an adjusted basis were just $3.97. There would have been $3.97, which would have been in line with the expectations. Analysts had called for earnings of $3.35 a share and revenue of $39.7 billion, which they missed by $1 billion. By $1 billion, yes. Wells Fargo was falling Friday after the bank reported a higher provision for credit losses in the fourth quarter. The bank's provision for credit losses was $1.28 billion, compared with $957 previously. The increase was driven by higher allowances for credit losses on credit cards and commercial real estate loans. Wells Fargo posted earnings of 86 cents a share, in line with Wall Street's estimates. Revenue beat actually at 20.49 compared to 20.3. Bank of America stock was falling after the bank's earnings fell short of analyst expectations. Bank of America posted a fiscal fourth quarter profit of $2.84 billion, or 35 cents a share, missing Wall Street's call for 4.38. So they missed by a bunch. Earnings of 53 cents a share was what Wall Street was expecting, compared to the 35 that was actually there. In a year ago quarter, it posted a profit of $6.9 billion, or 85 cents a share. So adjusted for one-time charges, Bank of America earned 70 cents a share, again, which would have been higher than the 53 expected. But obviously they had those issues. So revenue of 21.96 fell short of 23.7. So that's a miss again of $1.5 billion. CNBC brings us a little good news, a little respite from all the bad news from the banks. The producer price index, a gauge of wholesale prices, obviously fell 0.1% for the month and ended 2023 up only 1% from a year ago, the Labor Department reported. Excluding food and energy prices, the core PPI, which is the one that the Fed is going to look at, was flat against an estimate for a 0.2% increase. So the PPI was also, the PPI was, the headline number was also up 0.2%, which was in line with estimates. And trueflation continues flat at 2.19%. So the producer price index came in really, really good. The problem here is that, yes, you want that to be true, but as I've reported many times before, it doesn't, there's no correlation between PPI and CPI in terms of predictability. The PPI will not predict the CPI or the PCE, but it's still good. If it's flat, at least that component of what the consumer pays is flat, but there's so many more other components in terms of freight costs and labor costs at retail, et cetera, that go into the final retail price. Is too long to talk about here, but just so you know. But this will be good. The Fed will like this. And by the way, CNBC is reporting that traders in Fed fund futures are pricing in a 70% probability that the first 0.25% cut will come in the March meeting. Okay, this was down to 39. This was at 70 or even higher a week ago. Yesterday, after the CPI print, it dropped to 39%. And now today, after the PPI print, it is back up to 70%. But I think that's not just because of the PPI. I think that's because of the bank earnings. I think that the market is beginning to, I think a lot of people are beginning to think recession is coming. I'm saying it doesn't hit until sometime in the second quarter. We won't really see it until the third quarter. But I think was it Jamie Dimon that said this the other day? He said, we may not be in a recession in 2024, but it will feel like one. Well, that is definitely, I think, the feeling that we're getting at this point. Markets are now expecting 6 rate cuts, taking the benchmark Fed funds rate down to a target range of 3.75 to 4 point, which that is compared to what it is now at 5.25 to 5.5. So bonds will be what you want to watch as the crowd, if you will, decides whether to drive bond yields down in anticipation of either Fed cuts, a recession, or both. So let's see where the bonds are now, as excitement about the PPI print seems to be greater than worry over the bank misses, at least in the early going. But of course, we'll start first with Tesla stock. Tesla is down now a full percent, but it was, which is about $2.25, but it was down dramatically more than this a little while ago. And so it is headed pretty much straight up this morning, heading towards the green. We've got the Dow up 0.03%, NASDAQ up almost 0.5%, and we've got the S&P up 0.4%. All of those, the Dow is now actually fading, however, into negative territory, and Tesla has peaked and is starting down a little bit. See, this all just happens in real time. By the time you see this, who knows where it'll be. This 654 right now, and you'll see this at about 7:10, 7:15, or maybe you won't be in the first 5 minutes after I publish. And by the way, those are all California times. All right, so we've got the Magnificent Seven currently all in the green except NVIDIA. Little profit taking, but it's just slightly into the red. And you have got all the Cathie Woods in the green because why? Okay, we'll see. Because guess what? Bonds, yields, the 10-year has been going straight like this. The 10-year yields have been going like this all morning. We're now down 4.5 basis points. All of the long-term yields are down. We've got the 2-year actually at this point down 11 basis points, and everything's headed straight down except for the very shortest, like the 1 month and the 2 month, but everything else, including the 2-year, is headed way, way down. The difference between the 10-year and the 2-year now is, let's see, 937 and 48 is only just down to less than 3%. Is that right? Got to make sure I get this right. 15 and 93. Yeah, no, just above. Yeah, no, under 3%. So we're starting to see this yield inversion collapse. We've been talking about this for a while. There's a body of work that says that doesn't happen until the recession is already started, which could suggest, I don't think that's going to be the case. I don't think we're in a recession yet, but I do think I still think I haven't made a change in my thinking. I still think there's a 50% chance that we're going to be in a recession by the third quarter, but I will be looking at this really, really hard over the next few days, and I'll update you next week. We'll hear what Larry has to say. We know that Larry is truly believing a recession is coming. This show tonight is going to be well worth watching. I'm sure Larry will have some good thoughts on this. Okay, we got oil up $2.37. Which is absolutely to be expected. You have the Iranians taking over an oil tanker yesterday. You've got the U.S. government bombing some Houthi positions today. Lots of concern over there. So the West Texas and Brent are both up. Natural gas this time is up 8%. 8%. I'm thinking that I'm going to take a little piece of money and see if I can play this natural gas market. I mean, holy mackerel, 8.2%. Oh my goodness. Anyway, gold up 2.26% this morning. Absolutely to be expected. Copper and silver also up. We have got the dollar also slightly higher Friday. The dollar would have all kinds of mixed information to think about this morning. And then we have got, I think that's everything. Okay, so let's go back and see whether Tesla has continued in one direction or the other. Yep, back up. Yeah, in general right now, things are heading upward, and that includes Tesla, looking like it might even end up in the green today. What does that mean? It means probably that people are looking for opportunities down here at the 225 level. Saw some people this morning thinking it might go to as low as 215. But right now we're at 225 and headed higher, at least right now. I have no call right now. I have my original call. I believe it should be at all-time highs at the end of January, but everything is working against that, whether it's the press, whether it's momentum, whether it's the potential for a recession, whether it is actual negative news like Hertz, et cetera, and the drop in prices in China this morning. But none of that affects the fundamentals that I'm seeing, and the fundamentals that I'm seeing would suggest that there's every reason to believe it should be back at all-time highs. All right, so don't forget, all right, as promised, yesterday, Brian White and I did a video where we talked about what might the ramp look like. Look, Brian White are on exactly the same page that the Optimus is going to be a thing, and it's going to be a very big thing. The only difference between Brian and I is the timing. Brian says the timing is more 25 and 26. I'm saying the timing is 24 and 25. We go through what it takes to get Optimus to market. Where is it in terms of production? And we have different opinions on that. So that's why I'm highly recommending you take a look at that video. And then later today, and here's the card for that. And then later today, Brian Wang and I are going to take a look, and Brian Wang is going to absolutely crush every argument that you can possibly think of in terms of why there won't be 100,000 bots this year and starting to sell in the regular market outside of the Tesla domain. All right, so you're going to want to see both of those videos, and then all these videos anyway. Hit like, hit subscribe, hit notify, purchase these because you want me to remind you to do that. You know, you've got it on your list, but you keep forgetting. So do it right now. And then, and then finally, yes, join Patreon at the $3, $5, $10 level. Let's get this thing up to you where you can take a look at it. It has been great talking to you.